Hey everybody, Austin at Homeowners Financial, and we get so many questions about rates. Why are they moving? Why are they moving so fast? Where are they going to go? Well, the magic ball is actually broken, but let's talk about why they're moving and what we expect. So when you talk about rates, again, remember there's three main factors. There's your general economic policies, right? Like there's things from the GDP perspective, the price per index, right? All this economic data, all this economic reports, right? There's also capacity. How many people are able to service this and deliver that money to you, right? So if there's a high demand for rates, but a low supply of people, then your rates are going to go up. And then the last one, which is really, really the impactful one that's been so predominant in the past year and super predominant in the past month and a half, is policy. So you've got two factors going in play here. So first, on the Fed policy, yes, the Fed said, hey, they're going to raise interest rates 3 times this year. Now the Fed changes prime. They change the base lending rate. These are for lines of credit. These are for variable interest rate mortgages. This is for your car loans. This is for short-term debt. So prime, they expect to move 3 times this year, okay? The bigger thing is that they said they're not going to be buying as many bonds. So if you want to watch how rates move, literally just watch the 10-year treasury. And as that yield goes up, rates go up. As it goes down, rates go down, right? So that what they says, hey, gosh, you know, there's this inflation. So sorry, we slept on that for like 6 months. We need to stop buying bonds. We need to stop giving you this addiction to cheap money that's been in the market basically for the past 3 years. So they said, gosh, we're going to stop buying bonds. And you saw bonds move immediately. In December, the 10-year treasury was at 1.28. It's at 1.84 today. Now that 0.6 difference may not sound a lot, but that's over a 1% interest rate change, right? So the other thing that from a policy standpoint is what they changed is what's called loan level price adjusters. So now we're shifting from the federal treasury, the Federal Reserve, and we're shifting to FHFA, Federal Housing Finance Administration, that runs Fannie Mae, Freddie Mac, runs all these government loan programs. And they say, gosh, we realize that second homes have a higher risk factor. We realize that first-time home buyers buying in higher price areas have a higher risk factor. We're going to charge more money for that. Now, soapbox aside, it's ridiculous that administration says we want to help people stay in homes, but we're just going to charge you more money for it. Anyway, they don't listen to me. They don't listen to any of us. It's just a thing. So what they said is we're going to make this more expensive, and therefore you saw a huge change. So they're taking away the money that people are used to. They're saying they're going to be increasing interest rates, and they're saying they're going to make the money more expensive. That is like a triple whammy. And you have literally seen things move in the past month and a half over a point, maybe a point and a half in interest rates. So that's the information of why it's changed. Now let's look at where it's going to be going for. So it's the same factors, right? The same economic data. Well, the economy is recovering. Gosh, inflation's a thing. Gosh, the supply and demand. Well, there's still a lot of demand for cheap money out there, and without refinances being as attractive for some people, the supply and demand is evening out. And then the policy side of things, well, we've already said that, hey, they're going to be changing these interest rates overall. So the policy side leans towards that rates will be going up. I think you're going to need to expect to see rates go up at least another 0.5 point to a full point this year. Expect to see things in the 4s now, next month. But the most important thing to remember is that every 1% increase in interest rates means that you qualify for 10% less from a housing perspective. So I'll say it again, a 1% increase in interest rates means you qualify for 10% less from a housing perspective. And then the flip side of that, I was talking to someone yesterday and I said, his name's Josh, and I was like, all right, Josh, let's look at these. He's like, well, maybe I just wait, because if rates are going to go up, then prices are going down. I'm like, maybe. There's so much demand already that we're not going to see these prices just immediately fall. So therefore, if it's going to cost you more money and the prices are going to continue to rise, we really do need to strike where the iron is hot. So maybe that's not the best news you've heard, but my intent of these YouTube videos is to tell you the truth, tell you what's really going on. I am your ally in this. I want to help any single way that we can. My name is Austin. This is Homeowners Financial. Have a great Tuesday, and I'll talk to you soon. Bye.